Welcome back to another edition of Happy Half Hour. Today is Tuesday, April 8th. We're going to give the people what they want. A lot of hot tariff talk today. What's going on in financial markets, what we've done, how we see this going. Although this is a unique deal where there's not exactly a historical parallel. The range of potential outcomes is wide. If anyone is pounding the table about how this ends, that should be discounted because no one knows how this ends.
I couldn't agree more. Let's get into it.
Okay, so why don't you tell me how some of your client conversations are going around this?
Yeah, I think a lot of my conversations, not surprisingly, are people concerned about not just the direction of the market, but the speed at which it's going down. Obviously, we were down 14% in a matter of 3 days. So that gets people's attention. It's on the news and they become very concerned, which is understandable. So a lot of conversations with people, revisiting their goals and objectives, discussing the portfolio, how it's performing, why we've set it up the way we've set it up. You know, you and I were talking offline this morning, but I kind of think this is when we earn our keep. You know, when the market is going straight up for as it did last year, we still have to pay attention and make sure the portfolios are managed properly. But when things get difficult, I think that's when we really shine. And I think that's when we really earn our keep with our clients.
Do you feel like folks feel as if they're doing worse than they actually are?
Yeah, I think people, when they're looking at their investments, a lot of times they'll use a shorthand benchmark. So they might look at what the Dow is doing, or they'll look at what the S&P is doing. And if you look at those indices, they're down 13, 14, 15, 17% so far this year. So I think they tend to think when things are bad that that's how much I'm down. And obviously that's not the case with the portfolios we build and the way we construct them. A lot of our portfolios are down, low single digits. So 2, 3, 4%, 5%, not 17%, which is where the market is today. Now, it doesn't guarantee that we're going to continue to outperform in that way. And it's never fun to lose money. But yeah, there are a lot of people, I think, that are not doing as badly in their portfolio as they might think that they are, which again is a good reason to have those conversations and bring them up to speed.
One asset class of refuge which needed a PR makeover coming into this year was and is bonds. So bonds just got through the worst 3-year stretch that we've seen in a long, long time. And we've been saying for about a year now that bonds are probably more attractive than they'd been in a decade plus, with the Fed pausing rate hikes, inflation going down. Future bond returns are heavily influenced by starting yields. And when you look at where the capital has flowed to, as we've unwound and sold off, bonds have been a really nice safe haven, not only generating yield, mitigating downside, going up a little bit as yields have fallen. So things can change quickly. Probably one theme that we've seen, and I've talked about a lot with a lot of the prospective client portfolios that we've seen, some have become clients, some have not, but there's just been a mass love affair with the S&P 500, big tech stocks. And when you look at the greatest source of pain, it's been those two areas. So some of that, folks feeling like they're doing worse than they actually are. Some are doing worse than they maybe even think they are, just because they were performance chasing or crowding into the best performing asset classes of yesterday.
Yeah, it works that way on the upside too. Last year, if the S&P was up 15, sometimes clients would come in and think, hey, I should be up something close to 15. And we have to remind them that we're using a diversified approach. And a diversified approach means that you're going to have certain things that are working, but it also means you'll have some things that aren't working. International was something last year that was a bit of a laggard, and has been for the last, you could argue last 10 years. International has lagged U.S. stocks. But this year, we've seen a bit of a reversal there. While the U.S. stocks are down 15% plus, international stocks are flat to down, 1 to 2% type of thing. So that's why we're diversified, and it's been helpful for clients and their portfolios this year. What are some of the things that you're hearing from your folks, or what are some of the things you think they should be focusing on as we go through this, what is likely to be a volatile stretch?
Yeah, that's a good question. And I think good investing doesn't start after the market falls out of bed by 13 or 14%. So I always say good investing starts with a person being candid and open about their capacity to take risk, allowing us to build a portfolio that reflects their capacity to take risk. Kind of piggybacking off your comments, we aren't a hedge fund. Most of our clients are retired or about to retire. They're not looking to hit the ball out of the park. They're not looking to take on leverage. They've built their wealth. They're looking to preserve it. The skill set for building wealth and keeping wealth are completely different. So our job is to mitigate risk, manage range of potential outcomes, and it starts with building a risk-efficient portfolio. So most of our clients are well behaved. They're fine with what's going on. We tend to over communicate. Last week, I think we sent 3 different client notes about what we're doing. So at the start of the week, we took risk off the table. We sold roughly 6% equities across client portfolios, added that to fixed income. That helped mitigate downside risk. On Friday, when markets were squirrely, we sent another note about a range of potential outcomes with tariff. It's going to be a messy journey over the next couple months. And then on Sunday, for our Sunday coffee reads, we sent out a note about how clients can stress test their planning, stress test their retirement plan in the face of a disruptive market environment. So we're certainly dripping on clients. Our investment process is not based on what you think or not based on what I think. It's based on a preset schedule of rules, which we run once a month. Again, that allowed us to take risk off the table in a non-emotional, systematic way. And no one knows what happens next, but if things get better, if things get worse, we have a framework to make decisions given the market backdrop. I don't know if I answered your question.
You did, and I think something that has become more clear recently is a lot of times people don't realize how much risk they are taking or how much risk they're comfortable taking until we get an episode like this where the market, drops by 15% over the course of a week and a half. And it can be really eye-opening. When the market's going up, nobody's too concerned about how much risk they're taking. But when the market goes down and they see the losses that they're incurring, that's a good check to say, or if you're not comfortable with those losses, then you're taking too much risk overall, not just in the down stretch, but overall. So it's a good opportunity to evaluate, make sure that you're taking the right amount of risk, because you want to be able to stick with the investment plan, despite the volatility, despite the down market. And the last thing I'll say is, we've actually had a number of referrals over the past couple of weeks, because I think people are realizing, wait a minute, my advisor isn't doing what I thought they were doing, or my advisor is taking more risk than I thought because I am down 15% or 20%. And I didn't think that my portfolio could go that far. So it's a good opportunity for us with a disciplined approach to not only help the clients that we have today, but potentially help other folks that are maybe out over their skis from a risk standpoint.
And I'm about to tell the team this during our team meeting, but our highest growth year at Pure was 2022. And if you recall, 2022 was an awful year. Inflation up, rates up, every asset class down. That's because many advisors, many do-it-yourself investors don't know where the risk is hiding in their portfolio. A up market hides a lot of warts, and things can change quickly in this business. I've been through worse than this. I've seen worse than this. And I said to you offline, no one knows what the next crisis is going to be. I can set my watch to how people are going to react. And I think that's baked into our rules, some of the sentiment rules in which we use. It allows us to be a humble investor. I've been doing this for 21 years, and the further I get along in my career, the less that I know. So I'm very open-minded. I can change my mind. Again, our investment process is not based on what I think happens next. It's not based on what Toby thinks happens next. You would be surprised how many advisors make investment decisions based on their own personal biases and experiences, which now more than ever is becoming highly political, highly emotional. Humans aren't meant to process the reams of information that's coming at us 24/7. And it can lead to short-term bias, short-term impulse, and we want to strip all of that out of the investment process.
Yeah, and I think the last thing I would say on that is we serve a number of roles for our clients. Obviously, we have to build and manage the portfolios, adjust the portfolios, do financial planning, but we also have a behavioral component as well, where this is the time that if we need to be talking to clients or clients need to be talking to us, that's why we're here. We can help you understand the risk you're taking. We can help you understand what we're doing about it. And we could kind of work together to make sure that they're, not comfortable. It's not comfortable to see the market go down and see portfolios go down, but hopefully they're comfortable with the approach we're taking and the amount of risk we're taking, and we can kind of weather the storm together.
Let's shift to tariffs because we haven't really talked about this. What does your gut say on how this shakes out?
It's a loaded...
Yes, it is a loaded question.
Well, you saw Trump with the big Denny's menu or whatever that was, that all the different tariffs on it. I think that the tariffs, I think it's a tool that he's trying to use to bring additional revenue in, which would allow him to either lower taxes, cut taxes, etc. I don't think it's been very well communicated. I don't think it's been very well executed. So, we could go down that path, which I'm not sure you want to go down. But I kind of think that the tariffs is going to be something that he's using to negotiate and get something back, whether it's price concessions, whether it's help in other areas, whether it's sending a message. I think he's using it as a tool, but I don't think if he were to put in all those tariffs and everybody were to reciprocate, I don't think the global economy would be able to handle that type of an increase across the board. And I think people realize this, and I don't think that that's where we end up. But again, we really don't know at this point. What are your thoughts? I know you consider yourself kind of a tariff expert.
I don't think anyone's a tariff expert. Most people didn't know what tariffs were about a year ago. And I have to be careful here because we don't want to be political, but it was a shotgun approach when I think a more measured, targeted approach would have been better. I think the messaging has been inconsistent. Tariffs over the long term are bad. The free flow of goods and services across borders is a good thing for the global economy. Over the short term, I hope they're used as a negotiating tactic. But some of the stuff that's coming out now just doesn't add up. Like the US is the richest country on earth. We buy the most stuff than anybody on earth. And you're not going to have a balanced budget with a country like Vietnam or Cambodia. It just doesn't add up. We're going to buy more stuff than them. They make t-shirts, textiles, garments a lot cheaper, quicker, faster than we do. It seems as though someone's really, really smart or really, really stupid with how this rolled out, and it's tough to decipher which is which. But I firmly believe no one is going to be talking about tariffs in 6 months to a year. This is just another episode. You can go back over the last 10 years, whether it's the yen carry trade last August, bank failures in the first quarter of 2023 that no one saw coming, COVID even. Every crisis in the moment feels like the worst thing ever. 6 months to a year later, folks are going to look back and say that was an obvious buying opportunity. So right now, the range of potential outcomes is wide. Everyone on TV, everyone on social media, your friends are pounding the table on how they think this is going to end. No one knows how this is going to end. But again, if you can focus on the things you can control, your capacity to take risk, allowing your advisor to build a portfolio that reflects the way that you feel about risk, and have a non-emotional framework for making decisions going forward, I think you'll be better off than trying to panic sell and time when to get back in. I've seen folks play that game. It never ends well. The decision to sell is easy and you feel great, but what folks get wrong every single time is when to get reinvested. There's always going to be a mountain of things that could go wrong. That's the cost of admission. You can't get 9% a year, which is the long-term average for the S&P, without getting the dip. This is just the cost of admission for being an all equity investor. And the other thing I'll say is if your portfolio is down 5, 4, and 3% and you feel like selling everything, you probably shouldn't own equities. And that's fine. Again, good investing is being honest about your capacity to take on risk, how you've dealt with crises in the past. And if your portfolio is moderately down, you probably should not be invested in equities.
Yeah, but that's another example of let's have a conversation and let's talk about it. But you're right. The volatility we've seen in the market has been significant, but client portfolios have held up well. But if it's a good opportunity to double check the risk component and make sure you're comfortable with where you're at. I have one last related question on this. How do you approach these types of periods with your own investments, your own money? You're a very young man, still in your early 40s. So when you see these types of episodes, folks might be curious as to how you approach it or what you do, if anything.
So a lot of folks are surprised when I say this because I get the same questions on the golf course. And I honestly never really look at my personal investments. I'm 43 years old. I have a long glide path ahead of me. I rarely make a trade, or no, I rarely make a sell. I almost never sell anything. If I have cash, especially times like this, I shovel it into the markets and I don't think twice. I know that approach probably doesn't make sense for folks that are retired or about to retire, but for me, I'm a 100% equity investor. I fully understand the range of potential outcomes. I could get hit with a negative 30 or 40% year. I fully understand that's part of the game. And I don't blink when something like this happens. On the flip side, when markets go up, that's great, but I don't really give it much thought. I don't give my personal investments much thought. What I do think about is I'm a personal investor. Like I have an IRA, I've got a 401k. I own a business that's exposed to financial markets. So I'm almost double exposed. So from a risk management standpoint, I've looked into real estate and I've looked into some other asset classes, but that's more a risk reduction tool. Some of the same stuff we preach to clients. I don't want to get over my skis in financial markets because when things go south, I'll be double hit.
Yeah, I sold everything. No, I'm just kidding. No, I take a similar approach. I'm in my mid-50s, so I don't have quite as much runway to invest as you do. But yeah, I try to, not pay attention to my personal portfolio or not stress over it. If I'm comfortable with what I've set up and I'm comfortable with the risk I'm taking, then I'm just going to let it work. And if we get an extreme move, then maybe I'll buy more. And if we get an extreme run the other way, maybe I'll trim it back or rebalance it, but try to be very hands-off with the portfolio, even in times of stress.
One thing I said to you before we went on air was there's no certainties in investing. And this is another example that no one knows what happens next. The world is random. The global economy is a complex system. But there are few fat pitches in investing. And I think one of those is allocating capital during times of crisis. Putting cash to work during times of crisis is the closest thing to an investment fat pitch. And a lot of folks think that markets are less risky when they're going up and they're near all-time highs and things are great. Think 2023 and 2024. And then they think markets are super risky when they're going down. That's not necessarily the case. And it's really the opposite. When you look at history, when the VIX gets above 45, when credit spreads blow out, when markets sell off, that's usually a pretty decent time to put capital to work. So again, I know the opportunity set is different for folks that are retired or about to retire and they're spending down their portfolios. But for the folks that want to make a panic sell or do something irrational or emotional, know that history is not kind to that type of behavior. And usually when markets go down, that's usually a good time to get reinvested, to put cash to work, or even rebalance your portfolio if you feel like you're out of whack in one asset class or another.
Yeah, and it can feel very uncomfortable to do that, but it's the old, I think it's Buffett investing adage that the stock market is the only store in the world where when prices go on sale, everybody runs out of the store. So you would think if things were on sale, if you were enjoyed buying clothes at Nordstrom and everything went down 15, 20%, or they had a sale, you would think that would be a good time to buy. But with the stocks and investments, it sometimes works the other way. People don't want to buy when things go on sale a little bit. It doesn't mean that there isn't risk, but it's interesting that when the market goes down and people should be considering investing is often when they're reluctant to do so. In fact, they want to sell what they have.
Right. I'm pretty sure I'm beating a dead horse here, but close to, I'd say the third and fourth quarter of 2024, we had a lot of clients that wanted to get even more aggressive. So a balanced investor going to balanced growth or balanced growth going to 100% stocks. And I always tell those folks the best time to get more aggressive is when it feels like you want to puke, which is kind of what you were saying. Sure. I'm saying it in a more crude way, but the best time to get more aggressive is when you feel like you want to throw up. A lot of folks feel like they want to throw up right now.
Yeah, the last thing I'll say, and then we can move on, I've got a couple softballs for you,
Okay.
is that when the last year was a pretty docile market and we didn't make a lot of changes to the portfolio. We followed our process, we followed our rules, but our rules had us overweight equities all year. And it really didn't have much change last year. So we didn't make a lot of changes. In fact, we ended up losing a client because they were wondering why we weren't making more adjustments to the portfolio. And it was because the market was going in our favor. I use a sailing analogy. The wind was at our back. We had the sail out completely, and we were benefiting from that. As we turn to this year, and we've seen more volatility, it will likely occur that we will be more active with our investment framework, investment process, because things are moving and we need to be adjusting the portfolio. So, I tell clients that we're monitoring things, we're managing things, we will make adjustments as we go through this period together, but it's likely we'll be a lot more active this year than we have the last couple of years.
Yeah, and as markets started to break down the latter part of March, the early part of April, several of our rules flipped. And as I alluded to, we took some risk off the table, which just so happened to be before the stuff hit the fan. But more importantly, that is a very formulaic, rules-based, rigid process. Sure, we can tweak the rules, but we really lean into that, especially during a market like COVID, a market like this, where you can't really look at history and say, okay, this happened a couple of years ago. This is a likely outcome. The range of outcomes is really wide. We don't want to be making gut calls in this environment. As we saw from COVID, a lot of people that made gut calls during that environment ended up with egg on their face.
Yep, great point. So the last one I have for you, I know this is one of your favorite weeks of the year, Masters Week, golf tournament that gets played every early April. I got my Masters green sweatshirt on. Are you looking forward to the Masters this year and kind of decompressing from a stressful market environment by watching some golf, or what are your thoughts on that?
The Masters is one of my favorite weeks of the year. And this golf tournament I probably watch more of than any other golf tournament. One, because the coverage is great. I think it's not 24/7, but it goes without commercials for most of the broadcast. You can stream it. And I really hope Rory McIlroy wins a Masters. That guy's been so close. What a heartbreak last year at the U.S. Open. He seems like a really good guy. I mean, he could be an a-hole for all I know, but he seems like a really good guy. He's been through the ringer. He hasn't won a major in a long time, and he's playing probably better than he has at any point during the last 5 or 6 years. So I hope Rory finally gets a green jacket.
It's good. It kind of is a start to spring.
Yeah.
The Masters kind of makes you feel like, okay, spring is here. Obviously, they're in Georgia when they play that, so you get the azaleas and you get the feeling of spring and rebirth. So that's kind of, I enjoy it as well. I watch it as well and enjoy the heck out of it. So that's all good.
And we're kind of in a period where there's a sports lull. My kids are starting soccer, so I'm not talking about that. But just in general, like the NBA is winding down. It's kind of the dog days. It's right before the playoffs. The Blazers are out of it. So there's nothing really going on. So I feel like this is a good showcase for the game of golf. And all eyes will be on Augusta. And there's all these pools, and I've got some pools with my friends, and we just have a lot of fun with it.
Have you ever been to Augusta? I mean, not to play, I wouldn't imagine, but have you ever had an opportunity to go?
I got invited a couple years ago, and I couldn't go, which I probably will regret, but I'm hoping another opportunity arises. You?
I've never been, but it would be one of those bucket list items, would be fun to do. All right, last question I have for you, and then we can wrap up. And might be the most important question of the podcast. Minecraft movie. Have you seen the Minecraft movie with your kids that seem like they might be at a decent age, or maybe they're a little young, but it's the movie sweeping the nation? Have you taken your kids to see Minecraft?
My kids know what Minecraft is. They've never been into it.
Okay.
Like, they've played the game a little bit, and they just haven't shown any interest. So my kids are into Moana and Bluey and Sing, Disney movies. They're not really into Minecraft. But I can see the allure. I mean, I saw the box office numbers. It looked pretty good.
I've got kids. Mine are a little bit older.
Yeah.
So they're a little bit beyond the Minecraft age. But my two daughters, who are in their 20s, went and saw the Minecraft movie the other night.
And?
They said the movie was not very good, but it was enjoyable. Does that make sense?
Okay.
So, there you go. Movie reviews and everything for people.
Well, we'll put a bow on this. Happy half hour. Again, today is Tuesday, April 8th. I know things move quickly. We're going to try to edit this quickly so we can get it out. Last podcast, there was like a week and a half lag, so some of the stuff we talked about was antiquated. But we appreciate you all tuning in. Toby Weber, I'm Nick Shermans. Thanks for watching. We'll see you next month.
Cheers.